So, here we are closing out 2025, and what a year it's been for precious metals. We're seeing gold, silver, and platinum hit prices that honestly were pretty much unthinkable just 12 months ago. The big question on everyone's mind is, what is going on, and is any of this for real?
So what are we actually looking at here? Is this a permanent re-rating based on some new reality? A solid mountain you can build a portfolio on? Or is this whole thing just a speculative frenzy, a spectacular sandcastle that's about to get washed away by the next tide? Let's investigate.
You know, what we're witnessing is something historic, a nearly vertical climb in metal prices. The financial world has already given it a name, the Great 2025 Re-rating. And honestly, it has all the classic signs of a trader's call a blow-off top. Okay, let's just let these numbers sink in for a second. As of late December, gold is sitting pretty at over $4,500 an ounce. That's a 70% jump this year alone. But then you look at silver and platinum. I mean, wow. We're talking gains of nearly 170%. That's not just growth, that's parabolic. Even good old industrial copper is caught up in this, up over 41% thanks to a structural deficit. These are not normal market moves, folks.
So, what in the world is fueling this? A rally this wild doesn't just happen. You gotta look for the clues. And it turns out we're staring at a perfect storm of catalysts all hitting at the exact same time.
Okay, it really boils down to three massive drivers. First, the Fed cut rates 3 times this year, which, makes something like gold that doesn't pay you interest look a whole lot better. Second, you have geopolitical tensions flaring up all over, sending investors scrambling for the safety of hard assets. And third, central banks across the globe are buying gold like we haven't seen in decades, trying to get away from the US dollar. That is a very, very powerful combination.
But, the fundamentals only tell part of the story. To really get a grip on the mania part of this, we need to dive into the psychology of the market. And for that, there's no better tool than the one from legendary investor George Soros, his theory of reflexivity.
This quote right here is the key to the whole thing. Soros basically argued that markets aren't just a mirror reflecting reality, they're part of the reality itself. The price of something doesn't just reflect its value, the price can actually change that value. So, what does that actually mean in plain English? Well, think of it this way. What investors believe starts to drive prices. Then those new, higher prices actually change the real-world situation for the asset. And that change just reinforces the original belief, and boom, you've got a powerful feedback loop. We saw this with tech stocks in the late 90s, and we definitely saw it with housing in the mid-2000s.
So let's see how this thing spirals, right? Step 1, metal prices start to rise. Step 2, that gets attention, so capital floods into things like mining stocks. Step 3, the miners get all this cash, they pay off their debt, they start digging more, and suddenly their fundamentals actually look better. Step 4, the market's perception shifts. These guys are winners now. And what does that lead to? Step 5, the prices rise even further, and the whole loop kicks off again, but stronger this time.
And here's the crucial point. This is where it gets dangerous. After a while, investors just stop caring about the fundamentals. They stop asking if a company is a good value. All they see is that the price is going up, and that becomes the only reason they need to buy in. It becomes a self-fulfilling prophecy. So just how far down this particular rabbit hole are we? Well, get this. Right now, silver is trading almost 73% above its 200-day moving average. That is just insane. In the world of Soros, this is where you make the most money, but it's also where you're standing on the absolute thinnest ice.
So we've got the psychology down, but what does history tell us? Has this ever happened before? Oh yeah, this kind of parabolic move feels new, but the patterns are ancient. Let's dig into some history for clues about what might be coming next.
Think back to 1980. We had inflation fears, the Hunt brothers trying to corner the silver market, gold went nuts, spiking 130% in a single year, and then, bam, a brutal 20-year bear market. Or, remember 2011? After the financial crisis, all that money printing pushed silver to nearly $50 an ounce right before the music stopped and it came crashing down. So that brings us right back to today. And the big question, is this time really different? And you know what? There's a really compelling argument that this time is different. Unlike those past rallies that were mostly about money and fear, the 2025 rally is being propped up by a very real physical supply problem. Silver and copper aren't just for coins and jewelry anymore. They're critical ingredients for AI data centers, electric car batteries, and the whole green energy grid. This industrial demand creates a potential price floor that just never existed before. This puts us right at the heart of the debate. we've got evidence pointing in two completely different directions. So let's lay it all out. Are we in a new, sustainable trend, or are we in a classic bubble that's just waiting to pop?
All right, on one side of the coin, the case for this being real and sustainable, you've got the big money moving in. This isn't just retail FOMO. We're talking huge inflows into ETFs from pension funds. And like we just said, there's that very real industrial demand floor. But on the other side, the bubble argument. You just can't ignore a technical number like 72% above the average. And then there's the ultimate warning sign, public euphoria. When everyone you know who has never invested before starts talking about $100 silver, that's the kind of thing that tells you the final phase of a bubble might be.
Okay, so with all this chaos, what should we actually be watching? What are the key indicators, the tripwires, that can tell us if this rally is starting to run out of steam? Here's a really important rule of thumb from the history books. Whenever silver gets more than 30% above its long-term average, a pretty nasty correction usually isn't far behind. And just as a reminder, we are more than double that level right now.
All right, another huge one to watch is the gold to silver ratio. It's super simple. It's just how many ounces of silver you need to buy 1 ounce of gold. Right now, it's 57 to 1. Historically, when that number drops below 50, that's the danger zone. That's a classic sign of peak speculative fever in silver, and we are getting awfully close to that line.
Now, the source material we're looking at lays out a few potential ways to think about this. The key idea isn't panic selling, but maybe methodically trimming profits on the way up. For those mining stocks that have gone to the moon, maybe you sell enough to get your initial investment back. Take your initial chips off the table. And of course, keep both eyes glued to that gold to silver ratio as your real-time fever check.
And that really leaves us with the ultimate question, doesn't it? In these kinds of markets, the old saying is the trend is your friend, right up until the moment it isn't. Every single one of these parabolic moves eventually bends and then breaks. The multi-billion-dollar question for 2026 is simply, where's the breaking point?